Without any further delay, let's start. So good evening to one and all. Uh, my name is Rohit, and I welcome you all on behalf of Global Financial Consultants. I have been with GFC for past 5 years, and I'm working as a financial advisor. So thank you so much for joining us, and I hope you get a lot from tonight. We will have chatter box on, so if you have any queries, any questions, just feel free to drop there, and we will be more than happy to answer all your queries tonight. We have some fantastic speakers. You can see them online. They will be taking turns to speak. So Justin will be the first speaker, followed by Deepak. Before I introduce you to the speakers, I will quickly give you a background about Global Financial Consultants. So it's a financial advisory company here in Singapore. It was initially founded by Bruce Barron and Ian McMahon in year 1997. Back in Sydney, Australia, and then they relocated to Singapore in year 2007. Since then, we have been helping all our clients with their financial planning, be it any tax-effective savings or investments, or any future financial planning like retirement planning or kids' education fee planning, any term insurance, critical illness, SRS investments, CPF investments for Singaporeans and PR, as well as pension transfers. It is regulated by Monetary Authority of Singapore, and our main aim is to build a long-term relationship with all our clients by giving an unbiased advice. Recently, Singapore Finest had nominated GFC as one of the top 10 financial advisory companies here in Singapore. So that's a bit of background about GFC. We'll quickly move to our first speaker, Justin. You will see Justin on screen. So Tiff, can we have next slide, please? Yes. Justin is the Chief Investment Officer of Canaccord Genuity Funds and oversight of funds investment strategies, as well as managing the cautious, balanced, and growth funds. He began his investing career in 1994 and joined Canaccord in 2000. Wow, that's more than like 20 years now. He's heavily involved with the investment process of GWM and is the chair of the Portfolio Construction Committee, and is also a member of Asset Allocation and Fund Selection Committees. Justin is a chartered fellow of the CISI and is a former president of Guernsey branch of the Institute. So over to you, Justin, now.
Thank you very much indeed, Rohit. Good evening to you all, or good morning. I'm based in the UK, so it's still late morning as far as I'm concerned. But what we'll do today is, I think the title of it is Investment Strategy to Protect Your Wealth. I think we need to recognise that during certain periods, trying completely protecting your wealth is a lot more difficult. But actually, maybe it's more a case of adopting appropriate time horizon as far as your investment plans are concerned. Investment strategy shouldn't be just developed on a sort of 3-month or a 6-month view. It's about taking those longer term investment decisions. But what we'll try to do today is just to, well, first of all, we'll talk about the market background and what's gone on this year. We won't spend too much time on that because a lot of it you'll be familiar with. But what we'll then do is just move on to, I think, some of the main investment concepts that people, I think, investors should continue to remember. And again, sometimes when there's a lot of noise going on in markets, there's a lot of things happening. It can be very easy just to lose sight of those those investment concepts, which every investor should keep in mind when formulating their investment strategy. And then we'll move on to perhaps some of the more sort of recent market developments, looking at both positives, positive and negatives, and trying just to try to tease out really what's going on in terms of financial markets at the moment, and then looking at what the implications might be for investment strategy. So with that, I shall hopefully just be sharing my screen with you. So hopefully you can see now the title slide. So just to take a look at what's going on. Obviously, it was a very difficult first half of 2022 for most investors, and most assets lost ground, and it was just a case of how much ground was lost. Now, actually, the first half of 2022 was very difficult. July was a much more supportive market environment. Things like the US stock market, the S&P 500 is up 9%. Technology-related assets were up even more sharply. But even with the scope of those sort of rallies, when you're looking at the first 7 months of this year, it's been a case of most assets have lost ground. It's just really how much has been lost. What's been the worst places to have been invested? Well, actually, technology, despite the fact it rallied most strongly in July, still down over 20% for this year. Asia and China, emerging markets as well, have been very, very weak. Actually, where you've wanted to be, well, actually, probably one of the few assets that actually gained ground this year is really to do with commodities. As we know, the oil prices have spiked higher, partly as a consequence of what's going on with Russia and Ukraine. So oil prices are high. Latin America, which is a very commodity sensitive area, again has been very, very strong. But actually also what's notable here is obviously the bluey green bars here are all equity markets, and the grey bars are fixed income markets. You actually see it doesn't matter whether you've invested in equities or bonds or fixed interest, etc. Actually, you've suffered capital losses this year, regardless of that. And actually, that's quite an unusual development, because actually normally with equity markets going up, bonds are going down, and vice versa. And that's what we're just showing here to show how unusual. It's not completely unprecedented, but it's been an unusual period, certainly as far as the US is concerned, in that both bonds and equities have lost ground at the same time. So if we have a look back here till 1976, there have been 186 quarters since then. Now, there's been a negative quarterly return for both stocks and bonds on just 20 of those instances. So just 20 times out of the 186 quarters have both bonds and equities lost ground. But actually what's happened this year is that it's happened for 2 consecutive quarters. So obviously the first quarter and the second quarter of this year. And actually that's an even more rare occurrence. In fact, that's only happened on 5 occasions going back to 1976, where both bonds and equities have lost ground for 2 consecutive quarters. So that's what's happened. It hasn't been an easy market environment for most investors. And what's really caused that? Well, again, it won't come as much surprise that it's pretty much all to do with inflation and the corresponding action of central banks around the world, but principally in the US, to try to control that inflation. So as Rohit mentioned, I've been working for Canaccord as it is now for 22 years. I first started in 1994. Actually, so that was about back about here. Actually, in all the period that I've managed money, I'd never really known inflation to be too much of an issue until very, very recently. So it's for over sort of 30 years, US inflation broadly has come under control. Inflation spiked sharply higher. And obviously the key question is about how quickly will inflation return to those more normal levels that we've all been used to? And again, there's lots of views around that at this moment in time. And actually one of the slight concerns is that if we look back to the last period of when high inflation was the 70s and the 80s, actually it took quite a while for central banks to bring inflation back down to more sort of more reasonable levels. In fact, 1980s, it took about 3 years and actually 2 recessions, to bring down, inflation expectations and inflation, generally. So there's a fear that actually, now that we've let the inflation genie out of the bottle, it's going to take a long time, to put it in. And actually, many companies are using a period of high inflation as, should we say, an excuse to rise prices, to increase margins, and we got a kind of self-perpetuating cycle as far as that's concerned. And obviously one of the corresponding impacts in terms of interest rates. So again, here we're looking at, we're primarily focusing on the US just because it's the world's largest economy, but actually a lot of these precepts apply equally to Europe or Asia or UK, etc., etc. But again, it's pretty much, if we're looking here at the US, this is kind of the development of interest rates in the US. So this is, the blue line here shows where markets thought interest rates would be, this year, back at the end of last year. So actually, you can see markets were quite sanguine about inflation and interest rates at the end of last year. But actually, by March time, when it was clear that inflation was not coming under control as quickly as perhaps certain parts of markets expected, and that obviously the US interest rates had to go up to counter that. So you can see by the whereas at December last year, markets thought interest rates would only be about 0.8% at this year, end of this year. Actually, by March time, they thought there'd be 2.2, 2.3%. And actually, where we are now is that markets think that interest rates will be 3.3, 3.6, or 3.3 as it stands at the moment by the end of this year. So that's really caused the initial volatility and the initial drop in stock markets this year. But actually, why July has been a more positive development, more positive, we've seen more positive market movements, is that actually markets now expect US Federal Reserve to start cutting interest rates in 2023. Now, a question we've obviously all got to ask ourselves is, do we think that's reasonable? Is the optimism that we're seeing in terms of stock markets truly justified at this moment in time? I think our conclusion is that actually I would be extremely surprised if the US were to start cutting interest rates in 2023. In fact, it would, history would suggest that interest rates are going to continue rising, for a little while yet. Now, I don't think that necessarily negates a more positive medium to long-term view in terms of risk investment markets, but I do think it means that July might have been a bit of a more technical rally, and it would be reasonable to expect for us to give back some of that ground before we start to move upwards once again. But it's not just been about interest rates in inflation. Obviously, there are impacts in terms of what's going on in terms of economic activity. And then again, one of the major concerns of markets has been the fear of recession. And in fact, the US is now in a technical recession. But again, I think, it is a technical recession. I think it's going to be a relatively mild and a relatively short-lived slowdown. So this is the Atlanta Fed GDP Now forecast. This is trying to give us a more real-time indicator of what's going on in terms of economic activity, rather than the US GDP figures, which are only released once a quarter, subject to revision. So this is trying to give us a guide of what's going on in terms of the US economy more broadly. And you see, actually, yes, activity did slump towards the end of the second quarter and beginning of this quarter, but again, there are signs that activity is starting to pick up once again. So the slowdown that we've seen is going to be relatively short and short-lived. So that's again what's going on in terms of recent history. I think what we'll now concentrate on is to start look at a few of the longer term things that we should remember as investors, and which will stand us in good stead. The first is that actually, if you're concerned about delivering real returns, so returns above inflation, actually equity markets are the best place to be. Now, that's been proven over lots of different cycles and lots of different time frames, but basically equities give you the best real return, albeit it does come with periods of higher volatility, as we've seen this year. But again, bonds aren't necessarily immune to that, but again, the setbacks that we see in bond markets do tend to be sort of shorter lived. So if you are concerned about inflation and what it's doing for your savings, then actually it would argue about investing into equity markets. The other thing just to consider is that actually sometimes these falls feel very severe at the time. They're not nice to go through, but again, it's about adopting an appropriately long-term investment horizon. Now again, what we're showing here is, for example, the fall that we saw in 1987, the stock market crash at the end of the 80s. Again, that was a 31.5% decline. Actually, if you look back from now to then, it just appears a little blip. And in fact, this fall that we've seen this year in terms of US stock market is less than this. So again, maybe it's just about having an appropriate time horizon when you're making your investments. Again, just leading through to the view that actually, if you are concerned about inflation, where do you want to invest? Again, equities are going to be the place to be, because actually companies can pass on cost increases, to their consumers. And actually there's the opportunity for real profits growth from companies. So if we're looking over the long term at the correlation between US CPI here in blue and the S&P earnings per growth on the red, again, it's not exact, but again, over the longer term, companies can give you that inflation protection. Again, it's not been a great year. We know that. But again, we've had bad years in the past. We've had bad periods. And again, if you adopt that longer term view, in most cases, you will find that actually you will recoup back that money, that ground which has been lost in due course. So looking back again at a few highlighted issues, events, if we can put it that way, in history, where there's a Cuban Missile Crisis in 1962. Even I wasn't working then, but the oil crisis, 74 stock market crash. Actually, 1 year after those events have, once they've finished, then actually your markets are typically higher. Now, of course, what we don't know is, is this it in terms of, the stock markets, giving back, some ground, 24%. Actually, historically, isn't that great compared to some of those, some of these other periods. So could argue that maybe the stock market might retest its lows. But actually, fundamentally, we don't think that the economic environment, the investment environment, is actually quite that bad. It's inflation. Yes, it feels distinctly uncomfortable at this moment in time, but actually it's an easier thing to get the world economy out of rather than deflation. So arguably the global financial crisis was a much more severe event than what we're going through at the moment, because again, what the world hasn't had to deal with in the past at that stage was deflation. Actually, inflation, we know how to deal with that. It's a case of raising interest rates. Yes, it might cause a recession. Yes, it causes a slowdown. But actually, it's a relatively straightforward event to deal with, if we can put it that way. The other thing is just to be mindful of trying, don't try to be too discerning in terms of getting out of markets at just what you think is the right time, and then getting back in because you might be able to buy back at a lower price. You're feeling uncomfortable, because actually the costs of missing out of certainly for the best days in stock markets can be extremely significant. So what we've shown here is just the annualized performance of the S&P 500 going back all the way to sort of 1991. And again, if you just bought an S&P index tracker back then, actually you would have earned just shy of 10% per on average per annum, which again, I think most people will be happy to accept. But if you just miss the best day in each of those years, in each year between 1990 and 2021, actually that nearly 10% figure drops down to 6%. So again, it's okay, but nowhere near as good as your 10%. Actually, if you miss the best 2 days each year, your returns go down to 3%, and all it takes is just missing the best 3 days of each year, and actually you would have found that you would have basically trodden water for the past 30 years. You wouldn't have made any money at all. So be very careful about trying to time markets and getting in and out, because actually it's a very, very difficult thing to do. We are full-time investment managers, and we do not believe we've got long-term investment expertise in terms of trading markets like that. So just be a little bit mindful of these sort of factors. And again, it's just another way of looking at that same sort of thing. Here we're looking at global equities rather than US equities, and here we just looked at excluding the 10 best weeks of the going back to 2000 or 2000. And again, you can see how the difference between the return profiles has been quite stark. If you're looking at rolling 10-year returns, again, in most cases, I think 5 to 10 years is an appropriate investment time horizon. If you've got that 10-year view, virtually, for over 90% of the time, that 10-year investment into equity markets would have delivered a positive return for you. Just one very, very short period there around the time of the global financial crisis, where holding global equities for 10 years wouldn't have delivered a positive return. But even then, it didn't take much longer until you started to get positive returns again. So maybe it's more 11 or 12-year time horizon. So again, make sure we got the appropriate appropriate time horizon as far as that's concerned. And the other concept just to remember is that actually, yes, there is volatility as far as stock markets are concerned, but actually stock markets go up more often than they go down. Again, that's mathematically logical, because if they didn't, then ultimately they would become worthless. So yeah, stock markets go up more often than they go down, and actually they make more money on average when they go up than when they lose and when we go through down periods. So here we go, just looking at the daily moves of the S&P 500. So the number of times on a daily basis it goes up compared to goes down. Actually, it's up 55% of the time, and it's down 45% of the time. Actually, when it makes money, the average return has been 0.4%, and it's normally been lost 0.35% when it's lost ground on a daily basis. Now, these figures don't appear much, but actually, when you start compounding it over a 40-year time period, again, it makes a very, very significant impact to portfolio returns. And the other thing, just to remember, yes, US interest rates are going up. There's a lot of noise about how far they're going to have to go up, what's going to happen with inflation, etc. But actually, again, that doesn't mean there's necessarily, it doesn't mark the end of the bull market for stock markets. So again, just looking at the returns of the S&P 500 during times when interest rates in the US are going up. Again, there are periods of higher and lower returns, but again, it doesn't mean that the bull market is over. So there's a few of the investment concepts. Just for the last part of this presentation, we'll just have a look at some of the more recent developments in terms of what's going on in economies, what's going on in terms of stock markets, and perhaps what guidance it might offer us for where we might want to be invested with what's going on at this moment in time. Again, just going back to the inflation picture, and we'll have a look at a few sort of recent developments. What's likely to happen with inflation moving forward, given it has such a big impact in terms of financial markets. Well, actually, what we know is that certain parts of goods and services, and those which actually drove the initial spike higher in the cost of goods and services, they're just starting to roll over. So what this is some surveys done by the Federal Reserve Bank of Atlanta, and what it does is break down inflation into two component parts. One is the goods and services which change price or can change price very quickly and very frequently. So that's what's known as flexible prices. So here, just think, airfares, think about hotels, used cars, whatever it might be, because again, there's no impediment to changing those prices. And actually, it was those goods and services which are very much impacted by the fact we shut down the global economy during the pandemic, and we reopened it again, obviously during sort of the end of 2020, 2021. And actually, it was those year-on-year comparisons which had a big impact in terms of inflation. And actually, but it's just signs of that starting to roll over. And actually, I think the year-on-year comparisons would argue actually those sort of flexible prices are going to continue to fall down. What's slightly more worrying is that there's also a component called sticky prices, and those are the price of goods and services which actually don't change very often, or can take quite a while to kind of build up momentum in terms of price rises. And here, think of things like rents. For example, if you're renting an apartment or a house, etc., you'll probably have a 1 year or 2 year lease, etc. And actually, therefore, it will take 1 or 2 years for that inflation to start to be felt in terms of your rental costs. Again, just signs here that actually it is increasing again. And actually, that's probably what the Federal Reserve is more concerned with at the moment, because actually sticky price inflation takes longer to take hold, but similarly, it will be more difficult to bring under control and start pushing back down to that, maybe that 2 to 4% level, which ideally policymakers would like to see. Also, on the positive side, again, actually, markets are quite sanguine and quite relaxed about future inflation. So this just looking at markets' expectations for inflation, both for the next 5 years, which again is the red line here, and also for the 5 years beginning in 5 years' time. So 2027 to 2032. And actually, this expectation of inflation, which the US Federal Reserve pays very, very close attention to, because it's not just about where inflation has been, but where it's expected to be. Because clearly, if everyone expects inflation to continue at 10 or 15% for the next few years, that's when you start getting your problems, because as a worker you'll then demand higher wages to try and offset some of those costs, the cost of living, the food and energy costs. So actually, it's not just about inflation, it's about expectations for inflation as well. So actually, this is quite a good sign, because it does show that markets do believe that the Federal Reserve will get to grips with inflation, and it will remain relatively controlled. And again, some of the inflation that we have seen over the past 12 to 18 months has been because of supply chain issues, ports in China not being fully open. There've been big backlogs of orders. It's difficult to get necessarily all the goods that you want to, because supply chains haven't been working as efficiently as they have been in the past. Signs are, however, that some of those supply chain issues are or have eased and will continue to ease moving forward. But again, that's contingent on if we do get a further instance of China locking down Shanghai again and still implementing that zero tolerance approach to COVID, that would be an issue. But as things stand, all other things being equal, there start to be signs that those backlog of orders, those supply chain issues are not going to be as severe as perhaps we've been used to over the past few months. In terms of where interest rates are going, as I sort of showed you earlier, there's an expectation of interest rates peaking at sort of 3.3% before being cut in 2023. Now, is that a realistic expectation? Actually, I don't think it is. Certainly, if we're looking at real Fed funds rates, so this is the interest rates minus inflation. Actually, it's very, very negative at the moment. Arguably, with where we are in terms of economic activity and inflation, real interest rates should be much higher. They certainly should be above zero, at these sort of levels. But similarly, we're not at that sort of level yet, which typically would indicate a recession. Because actually, economic recessions are normally caused by interest rates being pushed up too high, which begins to impact on economic activity. And certainly, if you're looking historically at the start of recessions, the real Fed funds rate has actually normally been up around 4%. We're quite a way away from that yet, but it would argue that we do need to see interest rates much higher. And actually, historically, when have interest rates in the US peaked? Well, actually, they've normally peaked when they're higher than inflation. So again, this is looking back at what all the previous instances where interest rates in the US have been going up, and kind of the level that they peaked at relative to inflation. So in 1974, interest rates peaked at 13% when inflation reached a peak of 10.10%. So similarly, all of those periods, interest rates have peaked at a higher rate than inflation. So this is where we stand today. So it would argue, obviously, we do think inflation is going to come down, but even if it comes down to 4%, actually that would still argue that interest rates are going to have to go up much higher than markets are predicting at this moment in time. Global activity, I think it's okay. We have seen a soft patch during the second quarter. Actually, this doesn't really give you too much, cause for concern. Yes, growth isn't quite as strong as we would have seen, last year, but we're still expected to see positive growth, across the world, for 2022 and into 2023. This was quite an interesting chart that we came across, because there's a sort of saying that history doesn't repeat itself, but it does rhyme. And so sometimes there are quite there are periods where there's been similar developments in the past, and you can actually look at sort of what's going on in those. So actually, it's noticeable that there are similarities to what's going on in the world in 1968-69 as there was in 2020 and 2021. And actually, I think it's quite uncanny that the market reaction this year has been very similar to what we saw in 1970, actually. 68-69 in the US, there was an economic slump did begin in 1968. The US economy hit recession in 69. Of course, we know there was a very sharp slowdown in 2020 and 2021. There was also a pandemic, which probably isn't as widely known. In 69, there was a flu pandemic. There were 1 million deaths, obviously not quite as severe as COVID. We didn't go through the situation where we closed down vast parts of the economy, but there was also that situation. Lots of protests going on at the moment. Obviously, live Well, actually, I live on an island outside of the UK, but lots of protests in the UK, at the moment, whether it be sort of rail workers, whether it be on the legal system, etc. Lots of protests, going on. We've seen that also in the US with the Capitol riot, etc. Actually, lots of riots and lots of mass protests also in 1968, which is why it became known as the year of the revolt. And also there was a US presidential change. Obviously, we know what's gone on with Trump and Biden, and frighteningly, sounds like we might have a Trump president again next US election. But again, there was a change in US president from Nixon to Lyndon Johnson in that 68-69 period. So again, this would argue actually, if those historical parallels continue, we kind of argue that actually for the rest of this year, stock markets should be relatively supported. We'll see whether that correlation holds. Obviously, given with what's gone on this year, US stock market here, we're looking at valuations. Is it really cheap? Actually, you can't argue that. It's much cheaper than it was. So this is just looking at price earnings, ratios compared to the average levels. Again, it was very high. We're still above average, at the moment. So it's not screamingly cheap at this moment in time. But actually, where you might want to look is actually stock markets outside the US certainly offer a lot more value. So whether you're looking at Asia Pacific, etc., the PE ratio of that was just 10 times at the end of June. So actually, I would argue that if you're looking to make those equity investments, actually areas outside the US might be more attractive at the moment. The caveat is, of course, that if we do see further volatility, then historically, US fares better in relative terms than places like Asia or the emerging markets or Europe, which tend to be a bit more cyclical, a bit what we call higher beta. So they display a bit more volatility. Looking again at parts of stock market, again, there's a lot of debate. It's not just about where you're investing in terms of geography, but also looking at the types of company that you own, because again, that's made a very big difference this year, as we'll show you shortly. Obviously, the markets we put in are a sort of amalgamation of lots of different types of company, but that will incorporate both small companies, large companies, what we call growth and value, etc. Actually, again, if you're worried about inflation, historically, small caps have been a better place to be, certainly as far as the US is concerned. So again, looking back at every decade in the US, going back to the 1930s, small caps historically have returned higher rates than inflation. Actually, small cap value stocks, so value stocks being stocks which are basically viewed as being cheap. They've outperformed US inflation in every decade, going back to the 1930s. Small cap growth stocks, those which are expected to kind of grow their profits and their earnings at a faster pace than markets, have been okay, not quite as good as small cap value. So certainly the 2000s, when we were coming out, the technology bubble wasn't quite as good, and also again the 1970s, they lagged small cap value, but generally have been okay. As you kind of alluded to, again, there's been a big difference between what different types of companies have, how they performed this year. So actually here we're showing the difference in performance between small companies with a sort of growth bias. So again, small companies which are expected to grow their profits into the future, and comparing it to large value-based companies. And you can see there's been a massive underperformance over the past, which is 15 months, or it was been 12 months to the May 2022 there. Again, you have not wanted to be in those small cap growth areas. Actually, what we saw in July was a very sharp reversal in that trend, where actually small cap growth, which is the Russell 2000 growth, having underperformed so significantly, was up 11% in July, whereas large value, which is the Russell 1000 value, was up just sort of 6%. So a bit of a counter trend rally, as we call it. Again, I think on general terms, our view would tend to favour us more. Well, actually, I think it's more important to have a balance of investment at this moment in time. I think there are lots of unknown factors as far as the economic background is concerned, as far as the investment background is concerned. That argues for being having a balanced approach. Don't try to be a hero and pick exactly just the one area that you think is going to fly. Actually, I think the investment environment is so uncertain that you do need to have that broad spread of investments, wherever you can. It's about having diversification. Sounds very boring, I know, but actually I think in this sort of environment, it's the best investment strategy that you can have. Actually, I do think, however, that small caps are looking quite good value relative to large caps. So this is just looking at their sort of valuation history of the Russell 2000. So again, small caps relative to the S&P 500, which is large caps. And actually, markets trading pretty much as cheaply as it's ever been overall since sort of 2007. Now, yes, that's been this is only since the global financial crisis, but whereas historically, markets, historically, small caps have been a much higher valuation than they are at this moment in time. And again, I think actually what we're arguing here is just, again, looking at value versus growth. Value has underperformed for an extended period of time. Historically, value stocks, you'd expect them to be cheap, but the question is how cheap they should be. Now, again, on average, you kind of expect them to be trading at 75 cents on the dollar relative to growth stocks. That's kind of the average level. Actually, we got down to they were trading at sort of 45 cents on the dollar at the worst. It's picked up a little bit since, obviously since this year, but actually arguably there's much further to go if they return to kind of their historic trend. So just to wrap everything up, again, with anything, there's always positives and negatives. So which is again why we're arguing that any investment strategy has to contain a broad spread of investment. It might contain technology, it might contain energy, it might contain US, it might contain Asia, etc. But really try not to put all your eggs in one basket, because again, I think the investment environment is very uncertain at this moment. Positives and negatives. I think on the positive side, we have seen the US enter a technical recession, but I think that's going to be relatively mild. It's entirely possible the US Federal Reserve won't raise rates perhaps as aggressively as markets might have feared. Are they going to peak at 3.3 or 3.6% in 2023? I don't know. I suspect not. But again, it's just whether and how much markets move to sort of discount what might be a higher end rate for US interest rates. US tightening has started, but again, as we kind of showed, that doesn't necessarily mean that the bull market is over. And actually, whilst the US is tightening, we're also seeing economies, countries like China, for example, are starting to put some more stimulus into their economy. They have cut key interest rates recently. So again, there are areas where actually, if you want that tailwind for more stimulus, etc., they are available. It's probably just not in the US at this moment in time. Inflationary pressures are going to ease. It's almost mathematically certain that they will. What's less uncertain is how quickly they begin to ease, and what sort of levels they get to. We did see a good market reaction recently when US inflation had reached 9.1, came in at 8.5. Now, if you asked us 12 or 18 months ago, what would you think about an 8.5% inflation reading in the US? I'm sure there'd been shock and horror. But actually, because markets have got themselves so worked up in terms of inflation, actually and inflation had reached that sort of 9.1% level. Actually, that was viewed as being a good thing. So maybe we were seeing that peak inflation rate. Now again, I think that move from peak inflation is going to be a process. We're not suddenly going to see that 8.5% inflation go down to 2 or 3%. It's going to be a slow and gradual, hopefully reduction in those inflation readings, which will eventually allow the US Federal Reserve to begin easing back in terms of interest rate rises. And actually, again, it's very, very easy to be very negative when all you're seeing in newspapers and the media, etc., is doom and gloom. Actually, what you should be doing as investors is sometimes just taking a step back from that noise, actually saying, there will always be opportunities present. Maybe it's not in growth or technology anymore. Maybe it's in boring banks or energy companies, etc. But there are always going to be stock opportunities present. I guess your job, our job, is really to try to identify those opportunities where we can. On the negative side of things, company earnings, we've coming out of the US earnings season at the moment in time, actually it's been relatively positive, albeit it's been very flattered by very strong earnings from oil and energy companies. If you strip those out, actually it hasn't been that good, but it hasn't been a disaster by any means. But what it does mean so far is that the falls that we've seen in stock markets this year have been driven primarily by what we call ratings compression. So the PE multiple of the market has gone down. We haven't yet seen any impact from falling earnings. Again, you'd expect that actually company earnings won't be able to grow at the same sort of level as they have been, albeit, as we've said, at least with company earnings, you do have the opportunity to, for companies to push prices higher if their costs are increasing. We still don't know what's going to go on with inflation. Again, with all of us, it's a kind of a best guess scenario or best estimate scenario at this moment in time. Certain fears of stagflation, slow growth and higher inflation. Well, actually, arguably, we're in that sort of period at the moment. And if we're looking at stock markets, we're looking at the bellwether US stock market. It certainly isn't cheap. It's not ludicrously expensive, but it's not screamingly cheap at this moment in time. And then we've got the ongoing geopolitical uncertainty, obviously not just Russia and Ukraine, but China, Taiwan, Nancy Pelosi going to Taiwan, China not taking that particularly well, etc. And that's going to be rumbling on in the background. I guess the difficulty with those sort of things is you can't really formulate an investment strategy around, for example, whether China's going to invade Taiwan, because it might happen tomorrow, but it might not happen at all. So therefore, if you just started to put an investment strategy in place in expectation that China's going to invade Taiwan, you're starting buying lots of gold and holding lots of cash, actually you could find that in 2 or 3 years' time, you've missed out on some good stock market opportunities in the meantime. So unfortunately, it's one of those difficult things where, as far as geopolitical matters are concerned, you do have to be a little bit reactive, as far as that's concerned, in our view. So with that, that's me finished for now. Thank you very much for your time and attention today. I hope it's been of some use. I don't know if there are any questions, if Rohit, if you can see anything, if anything's come in.
Yes, Justin, there are a few questions. The first question is, what are your views on China equity market?
Broadly positive, actually. So China went through its sort of its stock market slump earlier than it did in the Western economy. I think if you're looking in terms of, again, we tend to look at the Asia Pacific region more generally, but as I highlighted, actually valuations there are more supportive. Again, there was fear last year about Chinese state intervention in parts of stock markets. There was obviously a clampdown on certain technology companies. There was a clampdown in terms of education companies, which led to some views that has China become uninvestable, etc., etc. I think the argument, the answer to that is clearly no. It does bring with it an expectation of higher volatility, of course, but I think actually a lot of what China's doing at the moment, actually they are stimulating. They are obviously trying to manage a slowdown in their sort of property sector, and obviously we've still got the controlled implosion in terms of Evergrande, etc. But that will be monitored. Again, the problem with China is that every time they've introduced stimulus into the economy, that's led through to further speculation and excesses in the property sector. So they've got quite a difficult balancing act to try to get stimulus to the economy without then fostering that speculation in the property markets again. But as far as when we're looking at it, actually I can see attractions for China, and I wouldn't be surprised as and when we look to increase equity weightings further, that we'll look for China as a potential destination for some of those proceeds.
Great. We have another question, which is, does Russia-Ukraine impact long-term investment?
Again, yes, no. I think I have to say, broadly no. And it's something that it's going to sound a little bit callous, but so let's just separate what's going on from a humanitarian point of view from what's going on from an investment point of view. Obviously, humanitarian impact, I think, speaks for itself. This is just looking purely and objectively at what's going on from an investment and economic perspective. First, we have to realize that Russia and Ukraine are relatively small in terms of the global economy. Where they obviously do have an outsized impact is in terms of food and energy, and obviously that's explained a lot. Also, some of what's gone on this year, obviously a big spike in terms of energy prices, food prices, as we know. Well, certainly I think we all know from going to the supermarket, etc. How much extra it's costing us at the moment. I think there are signs that actually that Russia and Ukraine as sources of supply are being supplanted by other areas and other regions. It just takes time to bring those sources of supply on board, and it's not something we can't suddenly flick a switch and suddenly we're getting all our energy and oil from somewhere else rather than Russia and Ukraine. It does take time to bring these things through. I think obviously the energy impact is probably the thing that's being most felt at the moment. Food prices, if you're looking at things like UN World Food Price Index, is starting just to show signs of rolling over. That again will take time to come through to supermarkets, but again it's kind of indicating that supplies is coming from other areas, albeit we are seeing some extreme weather in Europe at this moment, and what sort of impact that might have on harvest, etc., is difficult to say at this moment in time. I think what their impact will be still on energy prices, but again it will take time. I think we'll see whether there's an agreement signed between the US and Iran, which will then allow them to maybe export more oil, would be seen as more sort of positive development. We're seeing lots of things in terms of countries stockpiling energy. A few headline fears about we're going to see rolling blackouts across Europe this year. I don't think the situation is going to be that bad, but again it's just another kind of uncertainty in what was already an uncertain market environment anyway. I think fundamentally it's less of an issue now than it would have been at the big turn of this year, I'll put it that way.
Perfect. One more question is, what are the factors required to bounce tech stocks?
What's the factors that require a bounce in tech stocks? That's a great question. Well, certainly I think the tailwind behind tech stocks hasn't completely disappeared, but I don't think it's going to be as strong as it was in 2020 and arguably for parts of 2021. I think again there was a rush towards anything to do with technology, and there was a rush towards technology companies which weren't necessarily earning any profits, but where it was expected to be earning profits at some mystical date in the future. I think we have to realize that those sort of those game-changing companies, like the Amazons and the Microsofts of this world, don't come along very often. And as we saw after the technology bubble and burst, again a lot of these companies won't necessarily fulfill the lofty objections that are expected of them. I think we also have to realize that actually a lot of spending on technology was brought forward to 2020, and if we're going to see it return to trend, it would argue for slower growth from many of those areas moving forward. I think on the more positive side is the fact that actually valuations clearly are much cheaper than they were. But I think it just means, I'm not saying tech is not to be invested in. I think it just means you need to be a little bit more discerning in terms of your tech investments at the moment. Again, focus on quality, focus on higher cash flows, etc., and less focus on those what we call in the UK jam tomorrow. So companies which might be expected to return cash to or profits or become profitable 10 or 15 years into the future, etc. I'd have a bit more focus on their profitable here and now, stay away from those kind of unprofitable areas where I think sentiment has turned and will have turned for a while, quite frankly.
Perfect. I guess we have answered all the questions. So thanks a lot. Thank you so much, Justin, for such a great analysis. It's always worth listening to you. Thank you
Thank
so
you.
much. And now we will move to our next speaker, Deepak Singh. Deepak has been with GFC for nearly 8 years and has established himself as one of our top performing consultants. He specializes in financial planning, insurance protection for individuals and groups, as well as advising on CPF investments. Deepak currently has assets under management of approximately SGD 85 million. And tonight he will be talking about the SRS investment strategy and as well as inheritance tax on US assets for non-US citizens. So over to you, Deepak.
Thank you, Rohit. Can you hear me properly?
Yes, you are clear and loud.
So thank you, Rohit, and good evening, everyone. I hope everybody is enjoying the session today. Great insights by Justin, especially in this market situation, the way it has gone in the last 6 months. So I think there are a few good pointers which he made today is like invest with the right concepts. More importantly, like don't time the market. And as a GFC, as a company, we work with Justin and their fund managers to give more insights on that and a part of our investment strategy. So it was some good learning, and I hope the second half of the year should be good for the markets. And as you said, the inflation is going to ease down, and we can see the markets recovery. But as you said, like I always have a long-term view from a fundamental and market perspective. So I hope everybody had enjoyed that session and we brings more in the future. I'm here to talk about two topics as Rohit mentioned. One is a supplementary retirement scheme. So I'll start with that first. Tiff, can you change the slide for me, please? Yeah, so I pretty much, I don't know how many people know what this SRS, but I'll start with a very basic. So supplementary retirement scheme is a voluntary scheme which is done for the individuals to save for retirement over and above the CPF savings. Contribution to the SRS eligible for tax relief. Investment returns are tax-free before withdrawal. Only 50% of withdrawal from SRS are taxable at the retirement. Who are eligible? Singaporean citizens, Singaporean peers, and foreigners can they contribute to the SRS account. And pretty much the criteria is 80 years of the age. They should be not an undischarged bankrupt, not having a mental disorder, and capable of managing yourself and your affairs. So the very basically very simple rules are there, like 80 years, and if you have a CPF, you can still contribute to the SRS to get a more tax relief. And for the foreigners, it's more encouraged because you don't have any provident fund. So that's we can do that. Next slide, please, Stephanie. How to open a SRS account is very simple. You can open an account with these are the various options: DBS Group, OCBC, or UOB. So you can always go to your bank and ask for the SRS. You can always have only one SRS account to can have with one of the bank. Simple documents is identity card and passport, and of course the SRS declaration form. This can be given by a lot of bankers to you on this. So how it works is, let's say Mr. Tan, who is a Singaporean citizen and Singaporean PR, in this year he made a contribution up to 12,000 in a year. So yearly maximum for the Singapore citizen PR is 15,300, and for the foreign is 35,700. It's a cap of the year. So you have to do this contribution while in that year period. So like just for 2022, you can do it during January to 31st December. Then SRS operator will actually will automatically update IRS that you have done a contribution, and a tax relief will be given $12,000 for that year for Mr. Tan. For either Singapore citizen and PR, then you can go to $15,300. Remember one thing, and whenever you apply any type of tax relief, it has to be 80,000 given on that. Next slide, Tiff. This is basically a comparison which give you an idea of how does the SRS benefits you in terms of the income tax. So let's say somebody is earning 200,000 Singapore dollar, and if there's a no SRS contribution, the tax comes around 21,150. Let's say the same person who does it as a foreigner, if he contribute 35,700, then the chargeable income will be $164,000 and tax will be 14,724. So here he's paying 21,150 for the year, and here he's paying 14,724. So there's a little benefit given to you in terms of the tax relief for that year. This is on annual income of 350K. So if somebody is earning 350K, the tax come for that year is close to 51,150 without any SRS contribution. Where on this side, if we do the SRS contribution, it comes around 43,410, so almost close to $8,000. The benefit is given to you. So these are the the Excel sheet is available into the iOS, so you can always play with the number and find out what the tax reliefs are given to you. As I said, like SRS is a voluntary contribution, but only concern is SRS only give you 0.05% return per annum, which is very minimal. So what we do, we can always pull the funds out and you can invest into the SRS approved funds or SRS approved assets. So these are some portfolios which we are managing for our clients. So if anybody's have SRS, they can approach us and we can always construct a portfolio according to their risk profile and of course the time horizon. So these are the portfolios. I think this is a portfolio till the end of, if I'm not mistaken, June. The last 3 years, I mean, with all the market fluctuation and everything, the growth is around 38.52%. So pretty much better than the SRS return, which has been given by the bank. Last 4 years, close to 44.44. So it's again 11% CAGR basis. Again, the money is not coming to one time horizon. So every year, all my clients contribute to SRS and I pull the funds to buy on this. So these are the various ways to save your tax and also grow your funds like a retirement pot. And of course, the SRS investment strategy can be catered according to their risk profile and more importantly, the time frame which they are in on this. This is a very important topic which I would have been discussing this year with the different webinars and seminars, is how to mitigate the US estate tax. And this will be the topic which will be valid for most of the investors or who work for the US-based companies. So what is US state tax? So any client, when I say any client, is any alien. When I say alien, the aliens are pretty much who doesn't have any US citizen, not staying in US, and not a resident and don't hold any type of a green card holder over there. They are called aliens. So if any aliens, if they hold any US assets, are subject to a state tax on a death. So what asset does include? A mutual fund which is domiciled, mutual funds or ETFs which are domiciled in US, shares, so that's pretty much equities or property. So if any alien hold his assets, and if something happens to them in a death form, there will be a huge state tax. So the personal allowance is given 60K, which means that the first 60K is not taxable. But after that, a tax rate goes from 18 to 40%, which is a very big jump in terms of the state tax. I think for the US citizen, if you are a US citizen and if you're a green card holder, I think the personal allowance is almost to 3.5 million. But for the non-US citizen is only 60K USD. So how to avoid this estate tax? If the assets are held in an insurance bond, which we give a solution to our clients, they are not subject to state tax on the death of the life assured, as the owner does not die being a corporate entity. So what we do is that we transfer the shares from the platforms to the insurance bond, where you can hold the equities. And whenever something happened to the individual, their death is passed to the life assured companies, and as a life assured company, they never die. Holding asset on a non-life platform does not avoid state tax. So any platforms which you have a non-life insurance, they will incur the state tax on that. So we do not charge for the asset transfer. The insurance bond providers can be Quilter International, Utmost International, Friends Point International. So you can always, there's a different providers which you use for our as a platform where we can transfer the assets and avoid the state tax. And of course, it can be used for trading, which I can share in the next slide. But more importantly, remember that is these are the assets are held into this insurance bond, but it can be catered according to the different clients' requirement and their ticket size of the investment. That's why you use a different providers like Quilter, Utmost, and a Friends Life on that. So who are actually eligible for this? So any executive, any individual who is working for a US company, and they are given as a stock reward plan with them. So whenever they get vested, the vested shares are pretty much liable to pay a state tax if anything happens to the individual. Or any individual who like to invest into the US listed shares as Justin was saying, everything starts from US. There's a growth market in US, and most people are invested in the US market. So please look after your portfolio and think through that, how much allocation you have in US market and what type of a protection level you have in that. This is some example which I'm showing it to you that how the state tax works here. So take an example, Nick, a Singaporean citizen and resident, own US stocks worth of $500,000, which on death passed to the wife May. So the US state tax works like the taxable state is $500,000. There's a 60K as a personal allowance scheme into that. And 440K is the state which a tax gonna incur. And there's a different range. You can see that a different frame is there. The band which the state tax is there. So in this case, the individual will pay 125,400 taken from the 500K and pay to your loved ones, which you have put into as a beneficiary. This is for the Nick, who is a Singapore citizen on that. Second is a Sanjay, a Singapore citizen and resident, lives 1.5 million of US stocks to wife. And Tanveen, so the taxable state is 1.5 million. Exemption is $60,000, so 1.4 million. The tax is almost 521. So this is a very big chunk of money will be taken from the portfolio, which will be given to your loved ones. So as I said to you, like, make sure that you look into the portfolio, look for the allocation, how much of in US, how much you are exposed into this, and how can you avoid that actually. So this is an insurance bond. Insurance bond is almost like a trading platform. So it's not like something you're buying a bond where you're putting the money. It's an open architecture investment. So what does it do is it allows me to invest into various entities. So open-ended investment companies, you can do that. Private shares, which is you can invest into one of the private shares you can buy with some ticket size. Mutual funds, ETFs, some corporate bonds or fixed interest, stocks and shares. So what we do, we transfer the shares from outside of the platform to this asset because the assets can be held here right now. So it is still treated as a trading platform, but you get a layer of protection in this, which in the next slide will give you an idea. The insurance bond. So what is insurance bond is there's a 1% insurance is added into this portfolio, which you don't pay a cost. This is a non-cost to you as a 1% insurance. So let's say example, if somebody have a $500,000 US shares with a Morgan Stanley or Interactive Broker Poems, that this shares are transferred into this wrapper, or this is an insurance bond. And what happens, there's a 1% insurance on top of that. So if anything happened to the individual, the account will get closed. Whatever the market value is there, the market value plus 1% will be directly paid to the nominee. So you avoid the state tax plus the payment of the assets are very easy. It directly paid to your nominee. So as an insurance, 1% insurance, you can put a nominee and trust also. So it makes a life easy for the allocation of the funds after a death. But it's more about the individual to protect the state tax if you're heavily invested in the US market. But also sometimes the clients, most of my clients I've seen, they are pretty much invested into one single stock. So you can always transfer it here and can diversify the portfolio. So it's like the tech stocks has fallen to 20% this year, 25. You not get hammered into a one stock. Suddenly net worth asset doesn't fall to my 25%. So diversification is required in the portfolio. And more importantly, you can avoid all the state of tax on that. So that's for me. I mean, like if you have any question and I can answer that related to the SRS and state tax.
Thank you, Deepak. We have few questions for you now. The first question is, can we invest into global market? How much wide options we have?
You mean by SRS?
Yes, by SRS.
Yes, so we can invest into a global market through mutual funds. And this can be invested via SRS approved funds. And as I said in my sample portfolio, which I was showing to you, they were more into the global market. So yes, you are allowed to do that. I think you can tap every market, a single geographic location, plus different sectors. Again, it depends on the client risk profile and how they're gonna allocate the portfolio and what's the time frame you're looking to invest into this.
Okay, great, thank you. The second question is the US state tax valid for platform valid and interactive broker poems?
Yes, the US state tax is liable for the aliens who holds any form of assets in the form of like stocks or ETFs domiciled in US on a non-insurance bond platform. So any trading platform, if you have an exit more than 60K, there will be a state tax liable on that.
Okay, great. And I think that's it. Any more questions, guys? Please feel free to drop in the question and answers panel. No, I don't think so. Okay, perfect. So thank you so much, Deepak. Thank you for a great presentation. It was very insightful. And as discussed, all the topics, if you have any questions, you can always drop us any email. We'll be more than happy to help you. Or we are more than welcome to, you're more than welcome to have a chat with us. Deepak and I can help you with any financial planning, or if you have any questions, just let us know. So thanks a lot. Thank you so much for joining tonight, guys.